You're listening to the Option Alpha podcast from OptionAlpha.com, where we show you how to make smarter trades, learn how the stock market really works, and generate consistent monthly income. Now, your host and head trader at OptionAlpha.com, Kirk Duplessis.
Hey everyone, this is Kirk here again from Option Alpha, working every single week to make this the most popular investing podcast offered online because it's based on one thing and one thing only, and that's helping you guys make smarter trades. So again, thank you so much for tuning in today. On today's show, we are going to be talking about trading psychology and what I refer to now as the 5x2 victim matrix. And I know that's a lot and there's a mouthful in there, but hopefully the idea behind this podcast is just to get you to understand the different levels that you can take as you go through potential trading scenarios when bad trades happen or when good trades happen, and just trying to master your trading psychology a little bit. As I've said, I think a couple times now, and I know I've definitely said on daily podcasts, is that I truly believe that trading is about 20% what we actually do and 80% how we react to it or the emotions that we have as a result of trades that we make. And so most of trading, I think, is a very emotional game. It's, do I get in? Do I get out? Am I fearful? Am I greedy? What types of emotions do I have around a trade? And I think that influences a lot of what we do. Most of trading is actually very little of the mechanics, the actual order entry itself. A lot of it is kind of subsurface or subconscious, thought processes and psychology frameworks that we have either from previous experiences in the past or that we've developed over time. And so the goal with today's podcast is, again, to get you to help and understand just this one simple framework or matrix, as I'm calling it, for understanding this victim mentality that people potentially might have. I think this is actually coming at a really good time because if you're listening to this show, and this is November of 2018, well, we have just gone through, and we talked about on our daily podcast, so I won't rehash it here, but we just went through and saw that one of the, I guess, I don't know if you would call him a big player in the space, but it was definitely at least a more notable name, but optionsellers.com basically blew up their hedge fund as a result of short option contracts. Now, there's a lot that goes into that, and I could spend an entire podcast on this, which is why I did so in the daily podcast, which is now out by the time that this goes live. But the idea is that they blew up their hedge fund by trading short contracts, overly diversified, huge position size. So they broke a lot of cardinal rules or like cardinal sins in trading. But the idea behind it is, or the press that it's getting and the publicity it's getting is now kind of dovetailing and spinning on top of what people are doing on a regular basis with option selling, which is what we're doing. And I think it's now become more confusing as to who is right and who is wrong, or like what are the real risks involved. And so this is coming at a good time because I think people are starting to have really strong opinions and really have their emotions challenged on whether there is validity or not in options trading. And I think kind of going through this matrix might help you understand because you might put yourself in the frame of reference of somebody who maybe has lost all their money with optionsellers.com. So this 5x2 victim matrix that we're going to talk about today is actually not something I developed. So I will not take credit for its development, though I think we can apply it to the options market in a very unique way. So again, I do not take credit for the development of what I'm calling the victim matrix. I don't think they called the victim matrix in the book, but it actually comes out of the book, The One Thing by Gary Keller. So we'll link it up in the show notes and you guys can check it out. Probably one of my top 3 favorite books that I've ever read. I've read it probably 4 or 5 times now. I constantly refer to it. It has so many dog ears and marks and highlights. It's, looks like it's like a coloring book for adults almost now, but it's definitely one of my favorite books. And part of it is because of things like this, like these great graphics that are in the book that you can see. Now, this one is actually pulling out of, it's figure number 32. So again, we'll link to it in the show notes so you guys can get a copy of it if you want to. And obviously it's not like affiliate product. I'm not promoting it necessarily, but I think it's a really good book. But in this chart, what he basically draws is this matrix. He doesn't have it laid out exactly like a matrix, but it's this hierarchy of basically what happens after something happens to you. And he calls it a life happens event. I would call it a trading event. But when something happens to you, there's only 2 paths that you can take. And this is where the 5x2 starts to diverge. So you have 2 paths and there's 5 stages to each path that you can take. So we'll go through one side and kind of talk our way through it. And then we'll go through the opposing side, the different alternative or different route that you could take. take, the road less traveled, I guess, and talk about the 5 different stages. But everyone goes through basically these 5 stages, no matter which direction you choose. So you can go left or you can go right, you can go up or you can go down, whatever direction you choose of these 2, you go through the same 5 stages. But it's important to realize which direction you tend to lean to as a result of a trade happening. Now, this could be a good trade, right? And this is, this false positive sense of success that people have with trades that go really well. So I see this a lot in coaching where somebody buys an option contract and it goes really well and they have a false positive. But it happens more often potentially on the opposing side where we have a losing trade. And then we get into this mentality of breaking ourselves down and trying to figure out what happened, who's to blame or not to blame, et cetera, et cetera. And so my goal, again, is to help you understand how these 2 paths, one, diverge, the steps and the series of steps or phases that they go through, and then hopefully how it could potentially help you in your own trading. Again, I believe that if we understand how some of our thought processes start to evolve after a trade, we can then more effectively start to curb those thoughts or reintroduce different cues, different scenarios to help correct the ship, if you will. So let's start off with this basic understanding of just something happened. And let's use a bad trade, for example. So let's assume for the rest of the sake of the podcast that we have a bad trade that happened to us. And bad could be defined as many different things. In fact, when you're listening to this right now, you might hear the phrase or the saying bad trade and think totally opposite of what somebody else would. Some people might think bad trade means that you made a mistake or you had a trade that you shouldn't have been in the first place, right? That's what some people think of as a bad trade. Other people, myself included in this camp, would think a bad trade is nothing more than a trade that's just a losing trade. That doesn't necessarily mean that you did something wrong or that your analysis was wrong or your position sizing was wrong. It's just how the probabilities end up, playing out over time. We know we're not going to win 100% of the time. So my thought process is we should always expect trades to lose at some point. We should expect a string of losers, potentially even large losers at some point. And that's still within the wheelhouse of probabilities and expectations moving forward. But we start off with this idea that something happens. So a bad trade happens. Now, immediately you can start to diverge across 2 different paths. So this is immediately where these 5 steps start to take you in either direction. The first direction you can go is towards being accountable. So the first direction you can go is towards being accountable. This would mean that you basically are seeking some sort of reality as to what happened. Now, this is the path that less people travel, I would say. And this is the path that you should travel. So I want to talk about this first because I want you to have a good understanding of what the right trajectory looks like when something bad happens to you, then in this case, maybe a bad trade. But when you seek the path of accountability, the first step in there is seeking some sort of reality, not an illusion of what happened, but an actual reality of what actually happened in the situation. So did the trade go wrong because of something that you did, right? What is the reality of the trade going wrong? Did you have too big of a position size? Right? Or was it something else? Were you over allocated in one sector and you shouldn't have been, right? But it's seeking the reality of what actually happened, not some fantasy of what you thought might have happened. Oh, I think it's the Fed. It's the result of so-and-so. It's what Trump said or didn't say, right? There's all these things that people make up in their head as to what the true cause of something is. But when it comes to trading, there's probably not too many things that could really derail a trade. So you have to first seek reality and help understand what's happening. The second step or stage as you start moving towards accountability is to acknowledge the reality. So this is a tough part too. So first of all, you have to find out what actually happened, which is tough in and of itself. But then you have to acknowledge that what actually happened is the reality. If you over positioned and you had too large of a position size, acknowledge it. Just own up to it. Say, I had too large of a position size. Don't make excuses for why something happened, not the way that you expected it to happen, right? It's nobody else's fault ultimately, but on your shoulders, right? So the fact that Trump said something, or the fact that some, Fed official said something, or some politician or some company executive, or, somebody, some CEO said something, has nothing to do with the things that you can control, like position sizing, risk, allocation, right? Diversity. Those are all things that are under your control. So once you acknowledge that the reality is that something happened that you could or couldn't control, then you have to move to the next stage, which is you have to own up to it. And owning up to it is different from acknowledging it. Acknowledging it is saying, look, I know that this is actually what happened. So I found out that this is what happened, stage one. Number two is I know that this is what happened, meaning I know that this is the reality. So I'm not blind to it. I found it. I know it's the reality. Now, number three is owning up to it. And owning up to it to me means, again, realizing and taking a mental account of how you could have maybe done something different if you needed to do something different. So this is, I think, an important stage in saying, okay, if I know that I was overpositioned and I acknowledge that I was overpositioned, now I need to own up to the fact that I had too large of a position size and now need to maybe find a solution to change that. I need to redo my steps. I need to rewrite my rules 100 times so that I really cram the idea of small position size in my mind, so I don't make this mistake again, right? And this is where you basically take ownership. And I think that this is a stage that people take ownership of their reality. They really get towards that accountable stage in this third step of owning up to what happened, right? Or what didn't happen in a particular situation. This could also come in the form of, in many cases with a bad trade, and I'll air finger quotes bad trade. In many cases with a bad trade, it's nothing that you did. So it's not something that you necessarily did wrong. You didn't over allocate. You were properly position sized. You did the right order. It was the right strategy at the right time. You were balancing your portfolio. You checked all the boxes. And so this to me means that you just have to own up to the reality that there is some cyclicality and some loss probability in options trading. And this is okay. And that's a hard hurdle to cross over. A lot of people, when they lose on a trade, they think it's always something that they did wrong. And while many cases there are probably things you can do to improve it, sometimes you're doing everything right and it just ends up being a trade that goes sideways. And that's okay. It's part of the system. So number 4 is then finding a solution. So if there is something wrong and you need to correct it, you have to find a solution. So you're answering the question, well, what can I do about it at this point? And again, you're moving towards this accountability stage where you are starting to take ownership of the reality and then starting to actively resolve or find some sort of resolution as to how you can improve it. So again, if this was a bad trade because of position size, what can you do to improve your position size? Maybe rewatch one of the videos, maybe go back through some of the backtesting materials that we put out on how position sizing can impact returns, right? Kind of reinforcing some of these concepts in your mind. If you, let's say you missed an expiration date and got assigned stock. Okay, well, how can you make sure you don't miss another expiration date again? Do you put the expiration dates in your calendar, in your Outlook, or in your, iCalendar so you get reminders of them coming up? Do you do something different, right? Maybe the first of the month you start analyzing positions that are about to expire 2 weeks in advance, right? There's something you can do always to improve your situation, right? And that's stage number 4. And then the final stage number 5, is that you actually just frankly move on. And this is an important one because once you've understood what happens, you've taken ownership of it, you've, compartmentalized it into your own understanding and your own thought processes and your own growth, you find a solution. Now you just got to move on and just quickly go pie it. I think that one of the things I often hear before when I was playing football in college is that they would say that the best quarterbacks have short-term memory loss. And this is so true in trading as well, is that people harp on trades that go wrong, but truly the best people in trading understand that it's just part of the business. And so if you have a loss, you've got to quickly overcome it, learn from it, try to figure out if something went wrong. If it did, correct it, but then move on and don't be afraid to get into the next trade. That's why they talk about quarterbacks that are the best have short-term memory loss, because if they throw an interception or they make a bad play or they make a bad read, the best ones are the ones that get back out there and keep throwing the ball. I mean, keep chucking the rock, as my coach in high school used to say. Just keep chucking the rock. Good things will happen, right? And that's what we have to do with trading. We can't let one single trade or one event or one situation drag us lower and then be timid to get back into it. This has happened a number of times before, to me personally, with trades that just go bad, where we have like a bad string of trades. And I can think of rattle off like ticker symbols like TLT and FXE and EWZ. And we'll have just a bad string of trades, and yet we keep trading it the next month. And we'll get emails undoubtedly from people who will say, well, Kirk, why are we trading this? We just had, 3 losses in a row in this. And I will say, well, because I don't know what the next 3 trades are going to be. We could have 5 or 6 trades that are going to be profitable in a row. But if we don't trade, we're definitely not going to do anything, right? And it's just this idea of just quickly overcoming these hurdles and moving on, which is, again, something that most people don't do. So in this first half of the podcast, we've talked about this first path you can take towards accountability. So again, you seek reality, you acknowledge it, you own it, you find a solution, and you just move on or get on with it. The other path that people take when a bad trade happens or when a trading event happens is they take the path of being the victim. And this is the path that I think most people naturally gravitate towards. And it's not something that they do because they're bad people. I just think it's how we're wired as humans. I think unless we understand that we naturally try to tend to lean this way and have to really work hard to course correct and improve our circumstances, I think we just naturally fall into this pit. And look, there's a lot of reasons why the media, other people online, other educators want you to believe that this is the right path, because it's probably in their best interest in many respects to lead you down this path of, I call it negativity or being the victim. So what happens here in this path, and again, it's important that we understand what this road is so that we can understand when we fall into these pit holes and try to dig ourselves out of it. And that's what you should do. So when you take this path after a bad trade happens, the first step is you avoid the reality. This is so classic, right? Like when something bad happens, you almost kind of like shut off mentally. You, air fingers quotes, don't check your trades anymore, right? Just like you kind of like put them under the pillow and hope that something, really bad doesn't happen. But you ask no questions, right? Something bad happens and you're like, oh, okay, something bad's happening and I don't know what's going on, right? But you just kind of avoid it, right? Like the person you don't want to talk to at a Christmas party or social function, you just don't even go near them. And that's the first step. And if you do that, and if you know that you're like actually actively running away from a trade, you're heading towards the victim mentality. And that's never a good idea, right? So you've got to tackle things head on. You've got to analyze it, look at it. Everyone has bad trades. Every single person, every single trader, every real professional trader has had bad trades that are losers. It's nothing you should be afraid of. It's nothing you should avoid. You should actively run towards it, try to understand it. Okay. But again, when you're heading down this victim mentality path, you start avoiding the reality. Stage number two is you start fighting the reality. This is classic too. You think about all the things that are wrong with this reality of what's happening. So for right now, like take example, the oil markets. So the oil markets have absolutely collapsed over the last, call it 3 to 4 weeks, right? And everyone's thinking about all the reasons why it shouldn't be collapsing, right? Oh, it's this person. Oh, this is not what's really happening. There's these underlying technicals. People are just dumping it for no reason. But you're thinking of all the things that basically create this false sense of reality that you're putting up in front of it because it's not happening the way you thought it was going to happen. And that's really bad too. I for sure used to be like a classic example of this back when I started trading, and I was trying to day trade. I tried Forex. I tried everything when I started the first couple months. And I fell into this mentality all the time. I would fight reality. I'd look up news articles that would confirm my suspicions, right? Like, why isn't oil rallying, right? And you look up all these things and you get all these people who are talking about, oh, well, it should be rallying, but it's not for this. And it's just a matter of time. And it confirms all your suspicions. And that's never the right way to approach it. And I learned very quickly, because I lost money trying to do this initially, trying to figure out what works and what doesn't, that I can't fight the reality of what the market is. If there's a reason why oil is falling, I don't necessarily care to understand that reason, but I have to accept the reality that it's falling and that it could fall even further. And a lot of people, I think, got burned in this. Number 3 on this path towards being a victim is the blame game. And again, this I think is really the critical turning point. And this is where, instead of owning up to the fact that it's your result, it's your problem that you have, which is what people who are accountable do, people who are victims start blaming everybody else. I know this to be true because I end up being the scapegoat for people and they blame me for what they did in their accounts all the time. Somebody blows up their account, they blame Kirk. Somebody blows up and has a bad trade or a bad string of trades, it's not their position size, it was Kirk, right? So I know this and I accept this. I know that this is the case, but the reality is that if you start blaming someone else, you will never take ownership for what you actually control. And so people blame political figures, they blame industry reports, the Fed, the moon cycles. I mean, I don't even, whatever, currency, OPEC, I don't know, like interchange whatever you want here, but they blame somebody else for basically their misfortune and their malinvestment practices that they have. This is a bad idea. We all know things can go sideways. That's why rule number 1 and rule number 2 for me are position size and cash, right? You got to have your position size small because you truly have no idea where anything is going. And I firmly believe that the volatility we've seen recently is nowhere near the volatility we're going to see in the future when things really get geared up and this market really takes it on the chin and has some sort of a correction, bear market, whatever you want to call it. The volatility we've seen is nothing what we saw in 2007, 2008. I traded through those scenarios, right? That's VIX plus 50, plus 60, plus 70. That's insane volatility. We're not even close to that yet. So you have to own up to the fact that you control most of this. If you start blaming somebody else, you're already done, right? You're a victim of this market. Number 4 is they come up with excuses. So this goes hand in hand with blames, but the idea here is that you first externally blame someone else for what happened because you didn't understand or you didn't, take the time to understand. And then you have some sort of personal excuse as to why it's not your fault either. And this could come in the form of things like, it's not my job to worry about what positions to get into. It's not my job to manage my portfolio balance. It's not my job to watch the markets. It's not my job to do this. It's not my job to do that. All the reasons why you can't do it. Well, I don't have time to make all the trades, or I don't have time to analyze my portfolio. But I know for a fact that we all have time and should be making time for our investments. And if not, why are you working so hard to make money in the first place, right? If you don't care enough and have enough respect for your own job and what you're doing and how you're generating income, and then care and respect the stewardship you've been given to manage your own finances, then I don't know what to tell you. You probably are in this victim mentality, but you have to avoid this. We have to make sure that we take personal responsibility for whatever happens, however bad or good it ends up being. It's our responsibility. It's not somebody else's. Number 5 then is the last stage of being a victim, and they wait and hope for something to be better. And this is what people all do all the time. This is where I think in the trading world, people just put themselves on the sidelines and they wait for the perfect opportunity to come back in. Well, guess what? There's never going to be a perfect opportunity. Markets are imperfect. They never have the perfect buy signal or the perfect sell signal. That's what makes them so challenging to me and so exciting to me, and why I seek to understand them all the time is that I want to figure out what that is, but I know it's never a final destination. There's never going to be every single technical buy signal lined up and the stars will align, the media will align. It will be the perfect opportunity to buy or perfect opportunity to sell. But people who are victims sit on the sidelines and just wait. And they wait for things to be perfect. And then they basically wait themselves into oblivion because they never make any meaningful progress or steps. So something happens to them. Now they retreat. They go inside of their shell, right? Figuratively speaking, they start not trading. They start holding off. I'll wait till I have more money. I'll wait till my job situation improves. I'll wait till I have more time to watch the markets. But the reality is it's truly never going to make that big of a difference, right? You have to actively be engaged in this. You have to figure out a way to do it. Find a solution, as we talked about earlier. So hopefully kind of, again, looking at these two different paths you can take, you can already probably start to see where you've maybe fallen into a couple of these pits before. And like I said, I know I have too for sure. I recognize this all the time. In fact, this is like one of the dog-eared pages that I look at constantly, even like just regularly as a father, as a husband, as a brother, right? Like, this is who I want to be. I want to be somebody who moves towards accountability more so than being a victim all the time. But in the world of trading, this is really important because if you start moving towards this idea of being a victim, to me, this starts snowballing into catastrophic losses. You look at what, some of these other companies and hedge funds that blew up, and you start really asking yourself, which path did they take? It's pretty clear that they were taking the victim path the entire time. And even like the video, I guess, the apology video that went out was evidently clear that it was blaming, somebody else or how they didn't see it. They've never seen this coming. It's not, we were trying to look for rogue waves, didn't know it was going to happen, whatever. Like they didn't take too much accountability, in my opinion, on what happened. But I think that this understanding of this matrix, this 5x2 matrix, really helps out. So hopefully if it does, head on over to the show notes page at optionalpha.com/show 148. Let me know what you guys thought of today's podcast in particular, how you see this. And if you've fallen prey to this before, share your story. Like we're all here to learn and help and grow with one another, which I think is really cool about Option Alpha. And so my hope is that this just, again, sheds a little bit more light on how you could be impacted by these different trading psychology, things are pulling you in two different directions, and hopefully you start moving towards the path of accountability. So as always, head on over to the show notes page, optionalpha.com/show 148. Leave me a comment. Let me know how everything's going if you enjoyed today's show. All right, so let's get into the Trader Q&A segment.
And now our favorite part of the show, Trader Q&A, where we ask a question from one of our current members about options trading. Got a question you'd like to ask Kirk to answer live on the air? Just head on over to optionalpha.com/ask and hit the record button to leave a message. That's optionalpha.com/ask. And now, here's today's question.
Hi, Kirk. My name is Brian. I'm from Illinois. I've been pretending to trade for about 2 years now. I say pretending because I've been unsuccessful and not very consistent with it. I've been reviewing your materials for a while. I've been a free member, and I bought your signals and a couple of other products of yours. And I've been looking on the website recently trying to find some more information on Theta. I'm really trying to find online somewhere about how Theta decay works. And I've seen the graph that you presented before as well, where it shows that when you hit about 30 days or so, it has a steep decline in the decay of the option premium due to Theta decay. But I'm trying to find out if there is a difference between Theta decay and the graph associated with that when you're looking at options that are in the money, at the money, and out of the money, and how to either maximize or minimize Theta decay based upon choosing the strikes in relation to the actual stock price. Thanks, Kirk. You're great.
All right. Hey, Brian, thank you so much for submitting the question here and also for being a member, helping support what we do here at Option Alpha. With regard to time decay, I think time decay, as you already said, is a little bit confusing on the outside because you see the graphs, you understand that time decay speeds up, but then it's really figuring out how to maximize or minimize time decay or theta decay in your portfolio, depending on which side you're on. Here's the thing you need to understand about time decay as it relates to strike prices. When you have strike prices that are at the money or near at the money, those strike prices will usually have relatively higher levels of time decay compared to strike prices that are deep in the money or deep out of the money. And this is a result of the fact that strike prices near or at the money have, frankly, a higher chance of being in the money at expiration and are likely to see most of the activity, most of the volume, higher option prices because they're still fluctuating in the range of the expected move of the underlying stock. When you start to look at option prices or strike prices that are far out of the money, you start to see that time decay becomes smaller and smaller for those strike prices. And the reason is because those options have very little value, and therefore people are not willing to pay for them, even on a time value basis, for a small potential payout. And so as a result, they're just intrinsic or their true value becomes very low. And then time decay as a result of that value starts eating away smaller and smaller chunks because the value is already so low to begin with. The same thing happens generally with option contracts that are deep in the money. So when you look at strike prices that are deep in the money, they start behaving more and more like underlying stock. And so you take an option contract that's very deep in the money, that's behaving practically like stock, there's almost no value to it on a time basis because it's already acting like stock. So that's why the time decay aspect for those strike prices that are deep in the money also start to see lower time decay values, lower theta decay values, because it's already acting like stock. And again, there's no meaningful difference to the strike price being a little bit more in the money or a little bit more out of the money by the time of expiration. Again, it's mostly the at the money or near at the money option contracts that witness the greatest values for time decay and theta decay. Now, what does this mean for options trading? This means that if we are going to be option sellers, we generally want to be trading contracts that are either at the money or near at the money, and that creates the biggest benefit for us as option sellers. Now, we've confirmed this a number of times in studies, and it depends on the strategy and how far out you are from expiration, where you are on the timeline to expiration and implied volatility. But as a general rule, we want to be trading contracts that are at the money to near at the money. We've seen this before actually in tests that we've done where we've, questioned the ability of just selling options that are super, super far out of the money, right? 5 delta options, 2 delta options. Why not sell options far out of the money? High probability of success. Well, there's just no money to be made in those because everything's basically been sucked out of them. And you're basically trying to, as Warren Buffett would say, like smoke the last half of a cigarette butt or a cigar butt. And there's just no long-term value to doing that. So you're actually better off selling options that are, say, 15, 20 delta, 30 delta, or at the money as a general rule because they maximize this time decay and theta decay. So the opposite would then be true if you're buying options. You don't want to be buying options as a general course of business, but if you were, you definitely wouldn't want to be buying at the money or near at the money option contracts. You'd be trying to hit these home runs, which never really happens, but if you did, you were trying to hit these home runs by buying options that are further out of the money. So hopefully this answers the question. As always, I appreciate Brian for submitting the question. If you are listening to this right now, and I know a lot of you guys are listening to this right now, and if you have a question that you want to get answered here on the podcast or live on Facebook, as we've already been doing, head on over to optionalpha.com/ask. It is first come, first serve. Please click on the big red button in the middle of the screen and leave me a private voicemail. Again, there's no software to download or install. It's very easy. We need more of these questions coming in. So please head on over to optionalpha.com/ask, just like Brian did, and we'll get this queued up for the next closing bell segment. As always, hopefully you guys enjoy these, and let's get into the closing bell.
Now, the closing bell. Find out which stocks we're looking at right now, trades we're making, and hear our game plan moving forward.
All right, so in today's closing bell segment, I actually want to talk about a new trade that we did last week. We didn't make any trades this recent week here with Thanksgiving holiday. Everything worked out pretty well for us. It was a short trading week, probably one of the rare times that we didn't make any trades in a given week, which is very rare for us. But again, it was a very short trading week. But the last trade that we actually ended up making was in UNG. And the reason I think this is interesting is because I haven't traded UNG for probably 2.5+ years, and it's been on our watch list for a while. And in fact, I've even considered removing it from our watch list because we haven't traded it forever. And I used to trade it very actively, say 3-4 years ago. It was much more active, much more liquidity. It seems like the last 2 years or so, it's just been very range bound around like $20, $24 or so. Absolutely no volatility to speak of, no liquidity relatively to speak of. And so we just haven't traded it. But recently it's had a huge move higher. It's gone from basically $24 up to about $40 in a very short period of time. Volatility has exploded. Liquidity has come pouring in. And as a result now of this high implied volatility and us just waiting for a better opportunity to trade it, I think we can jump in here and make a trade. Now, we did actually make a trade in UNG by trading the 35 at the money straddle. So yes, this might seem like a crazy thing to do. And the reason, not the reason I wanted to do it, but it was just funny that this happened, that we're making a trade on basically the security and the underlying market that blew up option sellers. I think it's ironic because it gives people an opportunity to see how two different trades evolve side by side. My thought process on trading is always wait for generally higher implied volatility and then make more aggressive type trades because premium is higher. That doesn't mean we totally avoid trading, but when implied volatility is low, you underallocate, you keep your position size ultra small, and in many respects, you use risk-defined strategies, iron butterflies, iron condors, credit spreads, etc., because it controls volatility expansion. When you have something like UNG that had a huge move higher and is expected to have lots of volatility, that doesn't mean that you should avoid trading it. In fact, we've been active in trading it by selling these straddles at the 35 strike. But what's cool about options trading to me is that the fact that implied volatility is so high now and liquidity is so high, we were able to get $8.32 by selling these at the money straddles. That is an insane price for at the money straddles for UNG. And these are on contracts that were about 35-ish days from expiration. That's an insane price. So we're basically looking at an $8 range, right, in either direction for UNG, which is a massive probability range for us to look at. And it's not that I don't think the UNG is going to move. I do, but it basically has to move between about 26.5 and about 43.5. It has to move outside of those ranges for us to lose money at expiration, which means that this pop that it's had has to completely collapse or basically double, and then we can start losing money. Now, again, my thought process on this is I want to be active in this, but we're going to keep the position size in check as always. So even though I like this trade a lot, I like the option premium that we're collecting, we kept the position size small by just doing 2 contracts, which is more than enough margin to manage risk in this account and actually leave room to add more positions as UNG moves. So as UNG moves, we will add more laddered entries, which is a standard operating procedure and practice for us here at Option Alphas to spread our trade entry out over time. But by keeping position size small and just giving ourselves the ability to ladder into more trades, all under 5% risk, no matter what UNG does, even if it does break out and cause a loss, it's not going to blow us up. And that's the real key here, is that we can trade options. You can do it safe. You can do it in a systematic format that doesn't leave you exposed to huge amounts of risk, as long as you keep position size, cash, diversity of tickers in check. Some of the things that we've talked about on recent podcasts is avoiding the sequencing risk that really kind of allows people to blow themselves up, which is something that you don't think about. But again, this is where I think, people like optionsellers.com basically found themselves, is they found themselves in a bad string of trades all at the same time in the same market with high allocation and over allocation. And that is never a recipe for success. It never ends up doing well because Murphy's Law always is in place. If something bad's going to happen, it will, and it will happen just when you have too much exposure. So again, we ended up selling the 35 straddles in UNG. So we'll see how these end up working out. I think that they will end up working out pretty well. Again, we sold these about a week and a half ago, so they were the last trade that we did, which is why I'm talking about them here. But they've already started making a little bit of money. We'll see where they end up. In either case, is a good trade. I would make this trade over and over again. It's the right setup, the right position size. It gives us exposure into the natural gas market, which is on fire right now, which is great. And I think that a lot of people are pouring into these options, not really anticipating that UNG is going to potentially undershoot the expected move. So that's the trade that we're going to make.
Thanks for listening to the Option Alpha podcast. If you liked what you heard, please drop by iTunes and leave a rating or comment. Plus, you can get everything: free email updates for future shows, transcripts, video tutorials, case studies, and more. Just visit our website at optionalpha.com.
All right, so I hope you guys enjoyed today's show as always and got at least one thing out of it that you can apply right now to make you a smarter, more profitable trader and investor. As always, you can get additional resources, links mentioned in the show, and some related video training from today's show by going to optionalpha.com/show148. Again, that's just the number 148, optionalpha.com/show148. And until next time, happy trading.